Hello and welcome to Leaders in Lending. I'm your host, Drew Megrey, and this episode features my conversation with Jared Dreyer, the Vice President of Consumer Lending and Centralized Deposits at Westerra Credit Union in Denver, Colorado. In this episode, Jared and I first discuss Westerra's approach to building its own in-house automated decisioning engine, followed by an interesting conversation about the adaptive auto space. I hope you enjoy this week's topics, and without further ado, here's my conversation with Jared. Hello, Jared. Welcome to the podcast, and thank you for making the time to join me today.
Thank you so much for having me. It's a pleasure to be here.
Thanks. So, as we typically do on the podcast, let's start our conversation by rewinding a little bit. I don't know about you, Jared, but for me, as a child, a career in the financial services space definitely was not something that was top of my mind. So, can we start by giving the listeners a bit about your journey and how you got to Westerra, and on top of that, what's the day-to-day like as the VP of Consumer Lending and Deposits?
Sure, happy to. And like you were just saying, that wasn't my intent either. I went to college to do biology as my undergrad and wanted to study sharks in their natural environments out in the ocean. So I went to school in San Diego and decided to come back to Denver where my family was. And I got into mortgage lending and was quickly recruited by Wells Fargo. And they wanted me to run some of their retail branches. And so I got into the retail side of the business and did that for a few years until they merged with Wachovia, at which point I jumped over to Belco just because I really liked the credit union movement and wanted to be a part of it. I had some family members that were part of it historically, so I knew a lot about credit unions, and I wanted to be a part of that environment. So I came over to Belco, did retail there for a few years, and then actually led some of the retail team. And then because of my background in lending with doing mortgages and then also teaching a lot of the branch managers how to underwrite loans because we did have decentralized underwriting over at Belco at that point in time. I was able then to transition my career over into consumer lending at Belco and really loved the opportunity of building new products and services and helping better serve our members through the different lending opportunities that we had. And I found it a challenge to try to grow our portfolios while at the same time look for new areas of origination that maybe others wouldn't be in at that point in time either. And so we did a lot of cool, unique things at Belco. From there, Westerra had an opportunity because they had actually shut off consumer lending back in 2019 with a new executive team and executive staff that came on board. And so they asked, hey, will you come over here and help us rebuild the consumer lending platform? We'd like to start kind of from scratch. And the good news was it wasn't completely from scratch, but they said, we'd like to start over and really make sure that we're mitigating risk, but also helping our members with the types of financing that they need. And so I jumped at the opportunity to kind of build something from the ground up. And I really love the team over here and the leadership. So it was an easy move. And I've been very happy coming over to Westerra and really love what I do because I've had that opportunity. So I've gotten into some new types of origination. I've stood up some new software, as well as we've automated our decision engine to industry high standards. And we've had a lot of fun doing it. And we've been able to grow. Now, of course, with COVID and with the recent recession and liquidity concerns, it's been a little bit of a challenge. So like you were asking day to day, we're watching all those numbers and trying to do our best to balance serving our members' needs as well as keeping the credit union financially sound. And so we've had to lever and delever some of the stuff that we're doing. But I really love that because it's very strategic and it's very tactful and it's a lot of fun to do. So I've got a great team that I'm working with over here. And I just love every day coming in and working with them and finding these opportunities to help our members succeed.
Well, thank you for that. That is awesome. I would have liked to hear the path to becoming a shark expert as well. If you could have, funneled that into the part of your career, but I think that would have kept you overly busy compared to how busy you probably already are. But thank you for that. One thing I wanted to touch on, though, that you started to talk about there is around the decisioning engine, and something I found interesting when we spoke prior is, especially since I work in the space of automation within lending, is that Westerra has automated their own decision engine, right? So, Jared, on this topic, can we at least start by talking a bit about the reasoning as to why Westerra decided to build this engine, and then we can expand from there.
Sure, definitely. So when I came on board, Westerra was currently only automating about 8% of the decisions that were coming in through our LOS, and we use ArcOS through Origins, and it's a great system. It's built with Boolean logic, and I'll talk about that more as we talk about how we design this engine. But when I came on board, I knew that we were making inconsistent decisions. So, you may have one member that's trying to get an auto in their specific situation, and another member that may look alike, and one may be approved, one may be denied based on some outside factors or just a difference in underwriter. If they got one underwriter who is a little bit more lenient versus someone who's a little bit more conservative, there's a difference there. And I knew by automating our decision engine, we would have more consistent and fair decisions. But in addition to that, we really wanted to get back into the indirect auto space here in the Denver metro area,
Yeah.
because that had been turned off in 2019. And in getting into the indirect auto space, you need to be very consistent with your decisions. The dealers want to see the same decisions time and time again. So if they have that look-alike customer that comes into their dealership, they want to have that loan get approved time and time again as long as it meets our criteria. And they don't want to be going back and forth with the underwriters all day rehashing deals trying to get something to work. So I knew automation was going to be key to growing those dealer relationships and growing that volume of loan originations through the indirect network. And like I said, since it had been turned off, we were at zero, and we quickly over the next couple of years were able to grow it to the ballpark of about 25 to 30 million a month
Oh,
in
wow.
new originations, and they've performed very, very well. So it's been awesome to see the growth and to see the great.
That's great. And automation, of course, is something that is top of mind. And credit unions is an industry as a whole have always been the ones that have been kind of in the background and didn't automate, or they're not up to the most recent piece of technology. So when you guys were thinking about this automation piece, how did you leverage? Did you say, hey, let's get a room filled with engineers to build this? Did you outsource? Like, what was that kind of transition of, hey, we want to do this, but how are we gonna execute?
So the team had already met with one of our credit bureau reporting agencies, and they had done a deep dive for us, and they had some recommendations on what we could do. But coming over from Belco, I had the privilege of working with Cuddle back then. And it was actually CUDC before Cuddle purchased them and then transferred over to Origins. But with CUDC, we had Tom Helmers, who's now at Grow Credit Union down in Tampa. And he and I worked together on a decision engine for Belco where we used a custom score. And so taking the learnings I had from that, what I told the team at Westerra was, hey, without needing to pay for this or going through a third party provider out there, we can actually build it ourselves. And I told the team it's going to take a lot of work. It's going to take a lot of time. And so everybody needs to be very patient, but we're going to be able to build it ourselves. And I've shared this with other people in the industry, through the CUNA Lending Conference, or I did a white paper actually for CUNA on it. What I've told people is exactly what I just said. It takes a lot of time and it takes a lot of work, but it is totally worth it. So to build it out, we did a 5-year regression analysis of data from 2013 to 2018. And the reason we picked those years is because in 2021, those loans had all seasoned at least a minimum of 3 years,
Yeah.
and most charge-offs happened between 12 to 18 months. So we knew that the data we had was clean and that we knew what was performing and what wasn't. And we were able to take all this data for 5 years and break it into FICO classes, into loan to value classes, debt to income, unsecured to income, and payment to income groupings. And what we did is we did heat maps. So where were we normally approving the loans? Where were we normally declining them? And then what was the ultimate disposition? Did they perform or did they not? And by doing an overlay of all these heat maps, and like I said, it was a lot of work because we did this product by product. So we started with autos because that's where we wanted to go to first. We went to unsecured after that. And then we even did home equity. And home equity had its own challenges on top of it.
Yeah.
But we layered these heat maps on top of each other and were able to draw rule sets by saying, okay, so we like this FICO band, but we want to start cutting off our DTI at this point or cutting off our LTVs at this point. And we wrote those rule sets into ArcOS, and our automation went through the roof. So when we first turned it on, our autos were at 70% automation for both approvals and declines combined. And our unsecured products were over 60%. Our HELOCs, like I said, we had some challenges. And that's just because when you're dealing with the credit bureaus, you don't always know which mortgage is tied to which property, especially if
Right.
there's multiple out there. But we were able to automate 25% of those as well. So we've got some really cool automation built into our system now.
So to expand off that, kind of a two-pronged approach here is one, a lot around the decision, right? Is there anything in regards to the automation piece, full end to end? So applicant goes through either in-branch experience, online experience, the decision happens, and they're told, hey, yes, you qualify, or no, or is it just simply the decision engine? And then second to that is you started talking a bit about, we started with auto, went to the personal loan space, HELOC. Are you doing this today for just those three asset classes, or is it expanded across all?
Yeah, great question. So to answer your first part, the member does get communicated to their decision based on how they apply. So if they do it through our online channel, they're of course going to get that response online. We actually stood up a relationship with Lone Star, so we do point of sale lending through ArcOS as well. And in those cases, not only do they do the application through the Lone Star system, they get a text response, as does the contractor that they're working with, and they can go full end to end from application all the way through closing digitally. So that's a really cool feature that we've been able to deploy to them, where we can do closings through DocuSign and send all those out. So for the second part of the question as to what asset classes we're doing today, yeah, we started with auto, our personal unsecured group, and our home equity. Since then, we grew, like I was saying earlier, we stood up Lone Star point of sale lending. So we have now contractor loans for solar, home improvement, and we also did a Westerra energy efficient loan. We have added those three also to this space now. And we really look at them like an unsecured loan for the most part, even though we can do a UCC1 filing. And we've automated those pieces as well. The really cool thing, though, is solar. Since we work with the state and the Colorado Renew project here for our state of Colorado, we have set guidelines on what they want those loans to look like, and who they want us to be able to help. So we have fully automated our Renew program to 100%. So all the decisions are made by the system. We don't even have an underwriter look at it unless there's something that pops up like a fraud alert or a mismatch like on a social security number. And if we get one of those types of alerts, then of course, yeah, the underwriter is going to take a peek at it and validate all the information they can. But if everything comes through clear and passes all the fraud checks, those loans are decisioned and ready to move forward right away.
That's awesome. And you often hear, especially on the home equity line or even the mortgage product, the amount of time that takes, and then the real time that you're able to say yes or no to your members, I'm sure is much appreciated. So kudos
Yes.
to you, your team. I know that was probably a long time coming of building
Mhm.
this and being able to supply to your members. So again, kudos to you. Want to make a pivot here and talk about something that I know that you're very passionate about. And of that passion, I will preface that most lenders are not willing to touch this, or they probably don't know too much about it. And this is being the space of what's called adaptive auto. Can you first start by explaining, one, what adaptive auto is for those who may not know, and then why you're passionate about this space?
Sure. So, adaptive auto are handicap accessible vehicles. So, for our members that are in wheelchairs or have different paralysis that keeps them from being able to use gas pedals or brake pedals and whatnot, they're able to build these vehicles so that they can drive them. And adaptive auto is definitely an underserved community nationally. So not only in Denver, but anywhere that you guys live or any of your listeners live, they're definitely underserved there. And the reason they're underserved is a lot of lenders don't know how to underwrite those deals and they don't know what to look at. So let's rewind back in time. So this is back when I started with Belco. One of the branches that I ran, I would drive to work every single day, and at the off ramp, the exit to get to that branch was an adaptive auto dealership. So it was less than a mile from our location, and I saw them every day coming in, and I kept thinking, I wonder who's doing their auto loans and who's taking care of them. So I drove over and I asked, and they said, unfortunately, no one. They said, we can't get anyone to do loans for us. It's really up to the purchaser, the customer, to find their own financing for this type of deal. And they said most of them are doing home equity or trying to get money put together from friends and family to buy a vehicle so that they can meet just even their daily basic needs.
Yeah.
A lot of times, they may have a child who's disabled and they need to get them to the school, or it may be an adult who's trying to take care of their family and they may live on their own, but they just don't have reliable transportation to even get to the grocery store and back. So at that point in time, I realized, hey, this is what a credit union's for. We need to be able to help the members of our community and help them thrive. And so what I did is I started talking to our lending team at Belco about it. And I said, what makes the difference between an adaptive auto, so a vehicle that has a lift built in or some wheelchair assistance, versus a truck that has a lift on it, to lift it up higher so they can put the bigger wheels on or maybe the bigger exhaust. And I said, when we look at those vehicles that have those aftermarket customizations, we'll go into Kelly Blue Book, the KBB, or we will go into NADA, and we'll adjust the value for those upgrades that they've done. And unfortunately, you don't have the adaptive equipment listed. But I asked, what's the difference between this? And they said, really, there's nothing. So I came back and said, okay, so if we have an invoice, and the invoice says that they put $15,000 into this vehicle to put the lift in and the joysticks or whatever they needed to do so they could operate it. I said, why wouldn't we add that to the value of the vehicle? And they said, we certainly can. And so we started looking at individual deals just as a one-off. And through working with that local dealer that was just a mile away from my branch, they started sending their customers over to us at Belco and to my location. And because we had decentralized underwriting and I had authority, I was able to work on some of those deals.
Mhm.
And don't get me wrong, it wasn't a lot. It was maybe 1 or 2 deals a month at the most. But we would be able to find financing for them and help those members into those vehicles. So fast forward, now that I'm over at Westerra and we regrew our indirect group and started working on that, we started looking at a wider scale of how do we help these dealers across the whole state of Colorado. And in Colorado, none of them are on an indirect platform just because they don't do enough deals to justify it. And they'll say no one understands how to underwrite them. So we partnered and used our Lone Star partnership and said, hey, we've got a retail point of sale platform we can give you that you can use in your dealership. You can submit an auto loan directly to us, and we'll treat you like any other dealer. So we'll pay you a dealer flat on these, and we'll give you the same kind of income that you would get if you worked for an Auto Nation or a bigger franchise store out there. And these deals will come straight to us. You'll get an immediate decision, and we can fund them through ACH to you, and the member can close by DocuSign. And they said that they loved it, so we got that turned on, and we're now helping 3 different franchise dealers out there that have multiple locations that do adaptive auto, and they absolutely love it. So it's been really awesome to do. We would definitely want to grow that program, but we're definitely doing the crawl, walk, run, and we're kind of in the walk stages now.
That's awesome. That's awesome. One thing I wanted to touch on too is you said that not many people know how to underwrite this. Can you talk a little bit about the differentiation besides LTV, using KBB or NADA and such of how to underwrite this type of asset class in correlation to all other type of consumer lending?
Yeah. So talking to these dealers that do adaptive auto, they said every single finance company that they've worked with has always used just the basic KBB or NADA value, and they come in over the LTVs that are allowed at that financial institution. So whether it's a credit union or bank, a lot of them start capping out anywhere from 120% LTV, 140, 150, and they
Sure.
just can't do the deal. And they said, hey, we're financing a $60,000 Honda Odyssey minivan that's 5 years old, and KBB on it is $30,000, and we can't get the deal done anywhere. And it's because they aren't adding in those additional add-ons, the pieces that were manufactured and built for that van that increase its value. And because they don't add those in, and they don't have the box to click, when they're going through their automated LOS to say, yeah, it's got the spoiler, or yeah, it's got the running boards or whatever. They don't have the adaptive equipment there. So they just don't ever add it in or think about it. And then it doesn't meet their LTV criteria. And so it gets kicked out. So what we do is we get an invoice on every single deal that we do with them, and we will add dollar for dollar the equipment. So maybe not the labor, but we'll add the equipment dollar for dollar into the value of the vehicle. And the best part is when we started doing this years ago, both Westerra and Belco asked the same question is, whatever happens if we do unfortunately have to repo one of these vehicles, we can't sell it at auction. What does that look like?
Right.
And every single adaptive dealer has they've come to us begging, hey, if you ever get one of these vehicles, please bring it back to us because we can resell it and we can't find them at auction. So we've got a source that we can take them to offload the vehicle if we need to. Now, at the end of the day, we haven't needed to. I think that this asset class is actually very, very safe and very low risk because these families need these vehicles to survive.
Yeah.
I've not had one ever even go delinquent, and I say that and knock on wood at the same time that I say that. But I've been doing this for years, and I've never had one delinquency because they need these vehicles. So I don't think we would ever get into the position where the credit union would have to repossess one. But if we did, we do have an outlet by taking it back to the dealer if we needed to.
And that makes total sense. In that same regard, though, let's think about like in the auto industry as a whole. They might not be going delinquent, but they may get in an accident or have other type of issues such as job loss, deaths, so on and so forth. Can you talk a little bit about is there ancillary products that also come a part of adaptive auto as well?
Yeah. So just like any of our other autos, we can sell any of our gap products. We can sell our debt protection products onto these loans as well. When we do those adjustments, like I said, adding that equipment is just the same as having those additions onto a truck, or the running boards, things like that. So it's all part of the vehicle. It's all documented. We have it all in the file, and because of that, we get an accurate LTV, and the coverage applies to that vehicle just like it would any other. So we definitely recommend those products. We do get all of our products through CUNA, and we love our relationship with CUNA, which is now, and I keep saying CUNA, but it's True Stage. They just swapped over their name recently, but we love our relationship with them, and they take great care of our members with those.
That's great. That is an interesting asset class, and another kudos to you, your team, of exploring that asset class that many people, of course, need, but you don't really think about it too much when you're sitting in your chair. So, Jared, I think this is a good spot to transition. As we always do, I like to close the podcast out with let's call them three off the wall questions. So, the first being, what is the latest either application or piece of technology that you cannot live without?
Sure. So I'm going to start from a personal level. I
Okay.
am really big into Internet of Things and automation, even at home.
Yeah.
And so I use obviously HomeKit through Apple products, but I really love Home Assistant. And the reason is the Internet of Things is so new and it's so goofy, and you have so many different products out there. They don't all talk to each other and they don't all work very well together. And then things like Apple HomeKit have built in the safety measures that if you're doing automations when you leave the house or come home, it's always asking you to confirm it. And do you really want to open your garage? And it takes away the purpose of having the home automation, right? To even change things like your thermostat. Are you sure you want to change it? Yes, I'm sure. I'm coming home. Using Home Assistant, I've been able to go in and build a whole bunch of virtual switches. And by using these switches, you kind of bypass what HomeKit protections are out there. And so you can just do a switch that, hey, Jared just came home, it flips the switch. And then
Yeah.
I run automations based on those switches. So back to the Boolean logic, which is what we use to build our decision engine, which is really an if this, then that type of logic. I've been able to do the same thing and automate almost everything in my house. And so I absolutely love it when it works. And it works, 95% of the time, but that other 5% of the time, I'm troubleshooting and rebuilding it and making it work. So it's something that I can't live without anymore.
Now, when it breaks, like, do you have full access, or do wife and kids also have full access? But they can't mess with it, right?
Yep, exactly right. It's only me. I'm the only one who can go and fix it. And I keep telling my wife, if there's something you would like to have happen, or that you'd like to do, let me know. I can figure out a way to build it. And we have found really creative ways to kind of chain the logic to make certain things happen when you come home, when you leave. Here in Denver, when it snows, we've got some heat mats outside, stuff like that.
Yep.
And so building this logic into Home Assistant's been awesome.
That's great. I like that. I definitely like that. I'm gonna have to look into it. Fast forwarding, question number two. Hopefully, it's not shark oriented, or it may be. If you could switch jobs for anyone for a day, who would it be and why?
Without a doubt, it would be a Disney Imagineer working on park rides and the next theme park iterations. You can see behind me, I've got some Disney stuff. We are big Disney fans. We absolutely love going to the parks. That is our go to vacation. And I really love the Imagineer mentality of, yes, and just kind of building off of things and just imagining what is possible and how do we solve for it. And they come up with some really cool technology. They've come up with some really cool tricks of how they do distractions and things like that with their rides that they have today, and it
Mhm.
just completely astounds me, and I want to learn more. And so if I could do anything for a day, that would 100% be it. And I'd want to learn all the tips and tricks and all the secrets that they have going on behind the scenes.
Running trend of like more tech focus and behind the scenes. I like it. And then I'll close with the
Yep.
last one. It doesn't need to be in the confine of consumer lending, but what is one bold prediction for the future?
Sure. So looking forward, if you would have asked me this about 4 or 5 years ago, I would have been talking about autonomic cars. So the cars that were self-driving, that
Yeah.
were out there, just doing their own thing, like what Tesla's been doing. And there was a lot of rumors about Google, or maybe even like a Facebook company dropping a huge fleet into these major cities where they're autonomous and they don't have anyone driving them, but you could ride share them and do all that. I think COVID really derailed all that and took all the air out of that opportunity there. So, I know Apple's still working on a car. I'm watching that one pretty closely. Google's working on a car,
Yep.
but I don't think we're going to see it on that type of scale. What I think, though, happened at that same time that COVID happened was we saw a real surge in the Bitcoin and not just the cryptocurrency, but the blockchain technology, and blockchain really started coming to the forefront. And so my bold prediction for the future is I really think credit unions and potentially even banks, and it may even start with banks and then move to credit unions, will start to adopt blockchain technology and even potentially abandon their core systems. Because blockchain is verified by computers worldwide. Every transaction is multi-factor authenticated and not just verified, but trying to think of the right word here so we can delete that out. But it's verified, unanimously across the world. I think it's more secure than what we've seen today with core systems, and obviously hackers getting into those.
Yeah.
And I think we'll start to see a move towards that. Now, will it be a full 100%? People are going all into that. Probably not, but I think it'll start easing its way into things like titles. So anything from like a auto title to a deed on a house, and they'll be verifying all those pieces of paper instead of filing actual papers with the county. And then I think from there, it'll start moving in even into core systems and into online systems to verify transactions.
That's an interesting perspective. And I think it is going to be a crawl, walk, jog, run approach. But that's all going to be determined, of course. I would think more around how it's regulated. So it'll be interesting to see how that space expands. Well, Jared, again, thank you for taking the time to join me today. I really appreciated our conversation.
Yeah, thank you so much for having me. This has been great.